Bond investors are shifting their strategy, selling emerging market bonds from high-yielding countries, where governments have loosened fiscal policies, to those undertaking fiscal reforms like Argentina, Egypt, and Turkey. Joining us now with more on this and what to expect in the EM space, we want to bring in Timothy Ash. He is a senior sovereign strategist at RBC Blue Bay Asset Management. Tim, it's great to talk to you here. So when we take a step back on some of the patterns, some of the trends that you have been noticing regarding investor appetite and exactly what that looks like for bonds within the EM market, what are you specifically focusing on, and what does that signal then to us about some of that outperformance, what we have seen, and whether or not it's going to continue?
Well, as your chart suggested earlier, some of those big EMs have had pretty good performance, and we've now seen bottom-up turnaround stories. The last 5 years or maybe more, we just haven't had kind of good individual EM country stories, just highlighting some of those. Obviously, Argentina, new president, Milo, very reform-minded. South Africa, we had elections. We've had a new coalition, a dream coalition between the ANC and DA, and the assumption is that will push on with structural reform. Egypt has been one of the beneficiaries from events in Gaza. They've seen a big bailout from the Gulf states. And Turkey, we've seen a massive turnaround, or a 180, I should say, in terms of monetary policy. After last year's parliamentary elections, we had Mehmet Şimşek reappointed as finance minister, central bank going back to orthodoxy in terms of policy. And investors have rewarded Turkey. And they're actually rewarding countries that are doing the right thing in terms of policy. I could go on. The list is pretty long. Pakistan going to the IMF. We've seen some of the debt distress stories actually beginning to get resolution in terms of debt restructurings, the Sri Lankas, the Ghanas, the Zambias. There's been some really good stories, and that's encouraging.
I want to talk about how that applies to Asia and specifically China. Obviously, the government pushing forward several policies in an effort to get some stimulus going, particularly in the housing sector. What should investors know about what to look at to determine whether or not we've hit a bottom in China in terms of the deceleration of growth?
Well, I'm not sure we really have. I think if you go back 5 years or more, I think the assumption was China would inevitably become the economic hegemon. It would overtake the US through globalization by not getting involved in wars. They had a big balance sheet, lots of FX reserves. They were kind of central planned almost in terms of joined up thinking in terms of economic policy. They didn't make mistakes. What we know now, since the onset of trade wars and increased protectionism, is China actually does make mistakes, and there's overconcentration of power around Xi, less checks and balances. The real estate sector has been a disaster. And actually probably one of the conclusions the Chinese may well have drawn from the war in Ukraine is that if there's this long-term battle with the US, balance sheet is important and building up the defenses. Russia had this fortress Russia policy after annexation of Crimea. It deleveraged and it built up reserves because it was going into some kind of war with the West ultimately, and it kind of did. Mm-hmm. And the Chinese, I think, are looking at that and saying, well, we face a difficult challenge with the US going forward, build up our reserves, deleverage. And that means they're very cautious. In terms of stimulus, if you think back again in the last 20 years, every global crisis, the Chinese have pumped the global economy, or pumped the Chinese economy to kind of pull the global economy around. We're not seeing that. We're not seeing stimulus in scale. And I think it goes back to this idea. It's a very cautious monetary economic policy, I would say, because of this concern about the longer term trajectory in terms of relations with the US. So China, I don't think, is a particularly positive, constructive story. I think they're not going to bail out the global economy with stimulus. They're going to be very defensive. And with this overconcentration of power around Xi, the risks are that he continues to make policy errors. And obviously, China is systemic for the global economy. So I think China is still ultimately a risk.
So in our final minute here, to what extent does that play into the likelihood or unlikelihood of China doing anything to increase tensions with Taiwan, which for our audience of retail investors listening, that would be a huge headwind potentially for TSMC and, of course, a lot of the chip names. So it's something very critical to watch for investors.
Well, short term, I think the China conclusion from the war in Ukraine is that that if you're going to get involved in a war, you need a win. And I think China uses a lot of the military technology derived from Russian technology, and Russia's performed terribly in the war in Ukraine. I think the Chinese will be really nervous about their ability to win a war in Taiwan in the short term. I think it's less likely. Over the longer term, depends on the decisions taken on the economy by Xi. If he fails to turn around the Chinese economy and it continues to misfire, the risk of Xi, I guess, going to gunboat diplomacy and trying to, use nationalism and Taiwan, etc., to improve to improve his situation at home by playing that narrative will probably increase. So short term, less risk, I think, of a war over Taiwan. Longer term, it depends on the economic trajectory of the Chinese economy, which is not particularly hopeful.
Timothy, thank you so much for joining us. We really appreciate your insights. That was Timothy Ash. He is the Senior Sovereign Strategist at RBC Blue Bay Asset Management.